In data that has just been released, 40% of crypto trading platforms are DEXs. And so in this video, we look at why retail demand might be higher for DEXs and also why there might be some lack of awareness around investor protection. Today's episode is sponsored by Cake Wallet, where you can send, receive, and even exchange your crypto right from within the wallet. Cake Wallet is open source and non-custodial, so you control your own private keys. Available today on iOS, macOS, Android, and Linux. Good evening everybody and a warm welcome back to Enter Crypto. I'm Chris Kenyon and today we're going to be talking about decentralized exchanges. So these are DEXs, and we've currently had figures released or data released by the World Federation of Exchanges, otherwise known as the WFE, saying that 40% of all crypto trading platforms that are being used out there are decentralized. So today we're going to cover an article from Cointelegraph's Future of Money, and we're going to quickly read through the article as we do every day, and then we're going to comment after. So a report from the World Federation of Exchanges notes that 40% of crypto trading platforms are decentralized and use DLT technology, while the majority use central limit order books or clubs, quite similar to regulated exchange platforms. The WFE report says there are a total of 500 crypto trading platforms offering various crypto-linked products and services. The survey saw participation from several crypto platforms offering key insights into retail and institutional demands. Now, according to the report, many crypto platforms rely on off-chain club systems for price oracles, quote display, and order execution. These entities only use blockchain for settlement and custody purposes, meaning traders do not interact directly with it, which eventually helps save on transaction costs, and in this way transaction fees only apply when orders are settled on the blockchain. Crypto trading platforms with this type of arrangement are known as centralized exchanges, or CEXs. According to the WEF's survey, retail demand for crypto-linked products and services is higher than institutional demand. Except for custody services, institutional giants have shown a greater requirement for crypto custody services and higher demand. Based on the different types of product demands by each segment of investors, the report estimates that retail customers are less aware of the importance of investor protection. And regarding liquidity and customer demand, the report finds that CEXs enjoy higher trading activity despite decentralized platforms offering lower transaction fees. The report also sheds light on the difference in price for the same trading pairs on different platforms, leading to arbitrage opportunities. However, it claims this type of price fluctuation highlights a potential inefficiency issue in the crypto market. The report further finds that despite most countries imposing Know Your Customer requirements or KYC, both centralized and decentralized crypto trading platforms have fallen short in implementing such measures due to a lack of uniform crypto regulations. So some of the key differences, and I can speak personally about this as to why you would use a centralized exchange over a decentralized exchange, and vice versa, why you might use a decentralized exchange instead of a centralized exchange, is that going for centralized exchanges is really convenience. Now, I know you've got to KYC, I know you've got to submit documents and when you open your account and things like that, and there can be checks, security checks, but it is quick and it is easy, and the fees are usually low if you're using something like Litecoin or Monero. I know Bitcoin and Ethereum have high fees, but that's not, you can't really blame the exchange for that. That's just the network fees for withdrawing crypto. Whereas with decentralized exchanges, it's not always very convenient, but you are in control of your coins. On a centralized exchange, you obviously don't hold the funds. The exchange is holding the funds, and until you withdraw them, basically you're taking a risk with them. They're custodying your funds while you make the exchange, and until you withdraw that, they're in control. With a decentralized exchange, obviously you are in control, and the swap happens on chain. However, the fees are astronomical. On something like, on Ethereum anyway, I should say. I know that fees are cheaper on Binance and BNB chain and stuff like that, but they're centralized. So they're not, in that the network is centralized. Whereas you can say that Ethereum is sufficiently decentralized. However, the fees are just, anyone that knows, anyone that's used, Uniswap, for example, knows that if you want to do an exchange on Uniswap. When gas fees are high, then you're going to be paying through the nose. I have even made exchanges on because there were certain tokens that I could only get on a decentralized exchange because it wasn't listed on a centralized exchange, and I've actually stayed up sometimes till 3 or 4 o'clock in the morning just to do the exchange, because I know that the gas fee will be lower, and it might save me $100 in just in gas fees alone at certain times in the bull market we've had before. So there are fees that you need to think about when deciding which one are you going to use. And like I say, sometimes you might not even have a choice, because there are tokens, ERC20 that are only listed on decentralized exchanges, and if you like that particular project, you won't be able to go through a centralized exchange. But I think once crypto manages to get the fees down and is sufficiently decentralized so that people are not worrying that there can be a chain rollback or anything like that, or that they're going to lose, so that everything happens on chain, and you can pair that with low fees, I think decentralized exchanges are going to take off, and there will really be no reason to have centralized exchanges after that. Why would anyone use a centralized exchange that's got KYC and AML rules attached to it if they don't have to? If it's cheaper to use a decentralized exchange, then what's the point? What's the point of using Binance? So an interesting article, and it's interesting to see that DEXs are taking off and are, despite the high fees, being used, and actually they're in a bit of an uptrend as far as adoption is concerned. As always, guys, thank you for listening. Thank you for watching. Don't forget to, of course, like the video if you feel you got some value from the video, and I'll see you all tomorrow.